Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question for Bill, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. So without any additional delay, here's the host of today's program, Bill Bullington.
And we're back again. Hey, feel free to call us, 216-901-0945. You have a question regarding investing. The second most important thing in your financial life that you'll ever do is invest your money. First most important thing is save some of your money. But financial planning in a nutshell. Yeah, I keep threatening to write the book on financial planning for those people who hate to plan, which is, when it comes to financial planning, is pretty much 99% of us. 1% of us who really enjoy the process. And it's not as difficult as people would have you believe. You got to learn to live beneath your means. That's the hardest part of it. That is the hardest part of it. That's basically just budgeting. It comes down to just budgeting. Then you've got to learn how to invest the money and do better than average, which is not hard to do, by the way, because average investors do not make a lot of money, believe it or not. The average investor over the past 20 years, according to Dalbar, a firm that just does market research on investor behavior, about 2.5% a year. It's actually how much they've made. What's really interesting to me, and what we're going to be talking about at the next seminar that we're having, so if you go to my website, bullingtoncapital.com, you can sign up for it online. It's free. Corporate College, Tri-Cities Corporate College, they do a wonderful job there. Getting stuff ready. They have refreshments out. And this is a really nice evening, by the way, because the talks are always informal. The people there are always very nice. I'm always bringing research that I'm coming across, and since this is all I do, it's typically things you haven't seen from other people. And this is going to be November 17th, 7:30. That's going back to the 7:30 time period. It's we're going to be talking about a lot of different things. The major focus, by the way, in addition to the things that we just talking about at the seminar, say that 3 times fast. The major theme is don't buy a stock or fund, be your own fund. And there's a company that I use as a custodian. I have traditional accounts too at Fidelity, and I love Fidelity. It's a great broker-dealer. They do a lot of things very well. But if you want to create your own fund, you've got to use this firm called Folio Institutional or Folio Investing for the retail if you wanted to set up your own account. And then you can put together baskets of stocks. How am I going to do that? Well, one of the ways you could do that, I'm going to show you how to do that at the seminar, because this is close to the things that I do. But I have people that like to do things on their own, and I always encourage that. I think you should manage a portion of your own money, no doubt. I think it's a great exercise. And if you're going to do that, you need to do it relatively intelligently. I would think that you'd want to do that. And I'm going to show you how we do it and how you can do it too. So there's no cost to attend. The technology is off the chart. These guys are definitely ahead of the curve. They have been. Be interesting to see what happens when their patents run out. See if anybody else. My gut tells me that no one else is going to offer the services that they do because it is complicated in the back office. And for Schwab or Fidelity or Ameritrade, E-Trade, any of these guys to actually have to convert their current trading systems to this one would be nightmarish. The amount of effort that would involve would be astronomical. I have an idea how they can do it, by the way. I know how they can do it. So if you guys are out there interested in buying Folio, you want to buy this firm, people at PNC Investments, you might want to look at this. The PNC is local, by the way, and they're pretty good. But somebody might want to buy this firm because it's small enough to still be bought, and The technology is off the charts, and I know how you can implement it without having to reconstruct everything you've already done. So anyway, for the rest of you that are thinking about making money with your stocks, here's kind of what I'm talking about. There are sector funds out there, and the sector funds they advertise all over the front page, right inside the front page of Barron's, almost every week. They're advertising those sector funds, and those are fine. You do get to pick a sector. Here's my problem with buying them that way. When you buy it that way, in fact, I'll just use their ad as the example. This week's Barron's, right inside the front page, the sector ETF is holding, in materials, incidentally, is holding DuPont, Dow Chemical, and Monsanto. Those are the top three positions. And between those top three positions, it's about 28% of the fund. Does that sound diversified? 28% of the fund are in the three biggest companies in that sector. Now, if you didn't want to do that, because here's the problem I have with that. The companies that are smaller, the ones that are growing faster, are getting less money than those three companies are. Those are the biggest. Those are not growing quite as quickly as the companies, as the smaller companies are, because they can't. They're too big. These guys do billions and billions of dollars worth of sales every year. So here's what I'm telling you. You could literally download their holdings. I'll show you how to do that at the seminar. We're going ultra spy here. I'm going to show you how to be Eric Snowden's of the investment world. No, I'm just kidding. So we're going to download the positions, put it in a spreadsheet, say, okay, I want to be in the material sector because I think it's going to do well. It hasn't done that well. It's lagging the market over the past 3 or 4 years. I think time has come, but I don't like the idea of putting a third of my money into the three biggest companies who are growing who are going more slowly than the last three companies in the list. I'm not comfortable with that. So I download all the stocks on an Excel spreadsheet, and instead of putting 10% in DuPont and 10% in Dow Chemical, I'm going to treat them all equally. I'm going to invest equally in the smaller, faster growing companies right alongside the bigger, slower growing companies, as opposed to putting more of my money into the bigger, slower growing companies and less of my money into the smaller, faster growing ones. Does that make sense? If it doesn't, don't worry about it. Sign up for the seminar, bullingtoncapital.com. It'll make more sense when I show you how it's done. Okay. So this is a really awesome tool, and people don't understand it. They just don't understand. I get it. You've got busy lives to lead. But let's just say you decided that you like the materials. You looked inside Barron's by accident. You saw this ad. You saw the names of the companies in there, and you were really excited about it. How do you go invest it? Well, you can buy that fund, but if you do what I'm talking about, you're probably going to make more money, especially if you give it enough time. You give it enough time, inevitably, at some point in time, the fact that you've got an equal amount of dollars in the smaller, faster growing companies as you do in the bigger, slower growing companies is going to do better than putting more of your money into the bigger, slower growing companies and less of your money into the smaller, faster growing companies. Does that make sense? Now, if that doesn't make sense, that's why God inspired some people to make balance funds. So you can invest too. I'm just kidding. And no, I didn't take anything. Actually, I've had 2 Starbucks this morning, so that's why I'm a little bit wired. And anyway, if you'd like to call and break up this monotony, 216-901-0945, 216-901-0945. I'm really excited about being able to share this stuff with you. These guys have bent over backwards to help our little firm. And since we've been using them, we've more than doubled our size because we can, because the tools that we're being offered are significant, and they help. They can help you as an individual investor. They help me as an institutional investor. If I have an account, if I'm managing an account, and you say, hey, Bill, I really like, well, let's just pick one. I really like, let's say, the energy sector. I really like the energy sector. What is the best way that we can invest in that? So I give you choices. You can use the exchange traded fund. There's no problem with that. Or we can actually download the components of that fund and equally weight ours and give the smaller companies a chance. Because here's what's happening, by the way. I don't know if you've noticed, but about once a week, it seems, or minimally once a month, minimally, you hear about a company getting bought out by another company. And it's typically at a big premium. They're paying more than the stock price was selling for at the time. Otherwise, why would they agree to sell? So you're hearing about that quite often. And oftentimes it's the bigger companies acquiring the smaller companies. And that's been going on in that energy complex for the past couple of years. The smaller companies that weren't quite as well capitalized are getting gobbled up. So if you've got an equal amount of money in those smaller companies right alongside the big companies that are making the acquisitions, those little companies, when they get bought out by the bigger companies, most of the time it's been cash, sometimes stock too. So your returns would have been higher by holding equal dollar amounts instead of putting more money into the company that's acquiring those companies and paying a premium for those companies. And by having an equal amount in those smaller companies that are being acquired, it benefits you. So we could do that. We could absolutely do that. In fact, energy makes up about 10% of my high dividend model, so we're doing that anyway. But if you wanted to go further, you want to go deeper, and not that I really like energy that much. I mean, it's okay. That's a tough business. I would stay away from the pharmaceuticals because there's just an awful lot of stuff going on and much more stuff likely to come down over the next couple of years where the government's getting involved. And anytime the government gets involved, I want out. I do not want to be involved in an industry where the government takes a large interest in it. Because when they start putting regulations in, the government knows one thing they know how to do really well. One thing the government is incredibly effective at is slowing things down. They do that better than anything else. They slow it down to a crawl. That just infuriates me. But that's the way it is. So government's going to be involved heavily in your industry. Not all that fascinated by it, unless you're paying a big dividend and you got a pretty solid balance sheet, and at least I'm getting the dividend while I'm waiting for something to happen. Then I'll, invest some of my money in it. But generally speaking, if an industry or a company is highly regulated by the government, well, your opportunities are a lot smaller there to make those big outsized returns. So anyway, again, you can go, and we're going to be talking about all this stuff. I'm going to get through I'm going to show you actually a lot of the models that I run with the company that I run it through. We'll be talking about how to download the securities from these funds, where you can find resources available to find out which companies make up some of these funds. Occasionally just going through the list, you know how to do it. Look at the valuations on the funds. You can eliminate those that are the most overvalued, and in the long run, that'll help you. Avoiding stocks that are overpriced, that's kind of a big deal, especially if you're looking out over the next 5-10 years. There are a lot of companies that are selling at prices today they shouldn't be selling for at least 5 or 10 years from now. And that's if they continue to grow at 20-30% a year. That's the odds are not in your favor there. The same thing everybody was doing back in the late 90s on a much larger scale with technology stocks. Ask them how that worked out. And what is maddening, yes, those overvalued stocks can go higher, and at some point in time, some of them will. That can happen. Does happen. Happens all the time. They go higher than they should. And then they end up dropping and going lower than they should. Try to get somebody to invest in a stock then when it's down 90%. Nobody wants to do it. That's one of the reasons I have a job, because that is really, really difficult to get yourself to do. And anyway, so yeah, we got a phone call coming in right before I have to take a commercial break. We've got a commercial break coming up in about 2 minutes. But when we come back, 216-901-0945 is the number here. 216-901-0945. That's the number. You can call in and ask a question. If you missed something, you can go to my website. There's a copy of the broadcast on the website, bullingtoncapital.com. Or you can go to iTunes. It's the Bullington Capital Report. It's a podcast on iTunes now. And we're on iHeartRadio. So if you're not near a radio, but you'd like to catch the show or call and ask a question, I remember when we got on that, I had a client who was in a nursing home. And he'd been a really good client for an extremely long time period. We grew up together, basically. I grew up, he watched me grow up in the industry. It was one of the first clients I ever had in the business. And so he's in a nursing home, and he couldn't get the radio show. It was in Florida because he had a residence down there. And as you get older, I get it. You don't want to go through the winters here. So anyway, I sent him an iPad. I sent him my iPad. And I had set up for him iHeart on the as one of the applications. So he would literally, in the nursing home, he would listen to the program on iHeartRadio. How cool is that? Hooked up to their Wi-Fi in the nursing home, was able to hook up, and he actually called into the radio program while he was listening to it down in Florida. So I thought that was really neat. The fact that you can do stuff like that, and I got to tell you, technology is nowhere near where it's going to be. In fact, it just moves faster and faster until the government gets involved. It still moves a lot faster, but than it has in the past. And it's kind of like that big snowball. It starts off as a small snowball. You're about halfway down the hill, and the snowball is a lot larger and moving a lot faster than it was at the beginning. And that's exactly where we are as an economy. There's so many things that are going to change the way that people live. It's going to change the way we do things. It's going to change the economy. Actually going to change the world. And very exciting. And they're all positive changes. You'll get some negative side effects every once in a while, and occasionally we'll go in the wrong direction. That's okay. System is built to be able to handle that. It is. Our system is built to be able to handle that. The end result, by the way, we're going to talk about when we come back from these commercial messages that should start up in about another minute or so. Yeah, we're going to talk about what those types of changes can be. How do you position yourself to best take advantage of the positive changes that come about in the economy over time? What are the best ways of trying to make money on that in your portfolios? And it's kind of what we focus on all the time anyway, although I don't really talk about it that way. But when we come back from these messages, I will. You're listening to Bill Bullington right here on 1420 The Answer, so stay tuned.
Sail on down the line about half a mile or so, and don't really want to know.
Man, that is an old song. Yeah. Anyway, hey, you're listening to Bill Bullington. I'm here every Saturday morning from 11 to noon on 1420. Also on iTunes and iHeartRadio. So tune us in. Ask some questions. Send us in some questions. Be glad to try to answer those for you. I get here where we talk about the market every week. It's an extremely important part of most people's lives, especially today, because today you don't have CD rates that are above 5% anymore to rely on, and those are probably not coming back anytime real soon. They may come back one day, but probably long after I've retired. That's just the situation that we're in, which is not all bad news. I mean, I guess I feel kind of bad because an awful lot of people are going to have to take on more volatility than they would like to be able to maintain their lifestyle in retirement. It's just going to be the way it is. You've got to take on a little bit more volatility than you would like to. And, I have to apologize. I know I was going to come back with a topic that we finished, we went into a commercial break, and I can't remember what it was. So you want to call and remind me, that's fine. Don't get old, people. No, actually, my mind goes a million miles a second most of the time, particularly when I'm on the radio. talking and nobody's calling and asking questions because I feel like I'm alone in a room talking to myself. But you can call us and end that streak if you'd like. 216-901-0945. 216-901-0945. Workshop that's coming up here pretty shortly. We're going to be showing you some tools that everybody has access to. These are the tools that I like to use. I use them constantly. And it's basically building my own mini funds. I'm my own fund manager. In fact, the strategies I use for my clients are basically indexes, or they're actually what would be known as quantitative portfolios. That stocks have to meet certain criteria, stocks or funds. You can use ETFs too. I've got an ETF portfolio I like a lot. So none of them work like a lot of people think they are going to work. And what's really interesting to me, anybody who's stuck around long enough, say a 4 or 5 year time period, the vast majority of people have not kept up with the lowest performing model. Over that length of time, the vast majority will not keep up with the lowest performing model. And inevitably, it's because they jump around. They like to try to time the market. I see an opportunity here. And it's really based more on feeling or gut instinct than it is doing rigorous research and following a path that has been prescribed by the research that you've done. That almost never happens. In fact, if somebody were that astute, they're probably not calling me anyway. So I get the calls from people who want to try and manage their portfolios by emotion. And when you look at that, it is incredibly difficult to beat even the model that I use that has had the lowest returns. It's incredibly difficult. You know how I know that? 'Cause I've been doing this a long time. I got clients, they manage a portion of their own money, whether it's Fidelity or Folio, right alongside the other portfolios, and I can see it. We can see it. And we do that as an experiment. And it's interesting. It's fascinating. In fact, one of the strategies that I am the most fond of, which is it hasn't worked well now in 2.5 years. 2.5 years and it hasn't worked well. But you know what? I'm not upset by that. It does. I do wish it would start to kick back in, but I understand that that's how it works. I understand that there are going to be time periods when it's going to underperform by a lot, not just a little bit. In fact, Joel Greenblatt, one of my favorite authors, he's got a few funds out now. He was a hedge fund manager, was extremely successful. The little book that still beats the market is a very good book. He's got another book, Big Secret for the Small Investor, hasn't sold many copies. It's pretty good too. But the little book that beats the market, I really like a lot because this is a guy, nobody can argue with his success. He's been incredibly successful. And he tells it like it is. He doesn't tell you what you want to hear. He doesn't leave things out. He tells you like it is. Something I've always tried to do because you're going to find out. When you're investing, you're going to find out investing is tough. And if you don't have a lot of time, a lot of patience, and a huge amount of stamina, you're probably going to get to join the 19 out of 20 people who don't do as well as they would have done if they'd have just put it in an institutional balance fund and forgotten about it. Forget you even have the money. Okay, so long run, by the way, for what some people think is a very short slide. You know, if you can try to add 2.5% to your average annual returns over time, which for an average investor is not really that difficult to do. We'll talk more about that at the workshop. But if you can add an average of 2.5% extra, think about that. If that's compounding over a 10-year time period, you're going to have more than 30% more money. Over a 20-year time period, you're probably going to have 70% more money at just a 2.5% increase. And that's why I keep saying investing is the second most important thing that you can do financially. You've got to be doing well on your investments. Now, if you're worth $100 million, I don't think it really matters that much, especially if you spend less than $1 million a year. You can buy CDs or treasuries. You get $100 million, you get a 1% CD. I can show you how to do that, by the way, if you'd like me to. 1% CD, and you've got $1 million. And if you're spending less than $1 million, you have nothing to worry about. That's another thing I think is kind of funny. I hear this fairly often. Well, rich people, they just make so much money. As a percentage of their total, they're not the world's best investors. Now, a handful of them got to be rich by being excellent investors, but they are the minority, not the majority. Vast majority of rich people got there by owning businesses and doing very well with their business. When you look at their portfolios, they're not doing so well. Not that hot. So I think it's mind-boggling. In fact, most of those people, there's a product that's been created for them. It's called an investment-only annuity. Investment-only. Doesn't have all those death benefits, doesn't guarantee the principal like all those. But we'll come back to that in a little bit. But it's basically for tax-deferred mutual fund investing, and it's got over 300 funds. This fund family this company that I've been using just got bought out by Nationwide, which is actually a good thing. Now, they're not going to raise the fees on it. The fees are only $20 a month. Doesn't matter if you have 25,000 or 25 million. Their fee is only $20 a month. Now, you compare that to any of the other annuities out there. In fact, if you don't know how to find out what you're being charged, contact us. Go to our website. We've got a service for you. We work with that company directly. We'll analyze it. We'll find out what you're being charged, and we'll show it to you. And if we can show you a way of saving money, we will. And if we won't, we'll tell you that too. So the annuity comparison service. Go to my website, bullingtoncapital.com. You can click on the Contact Us page and just fill out the information there. Send it, and we'll be glad to get back to you and see what you can do. There are an awful lot of annuities out there that have been around for a very long time. Some of them are not bad. Some of them that are really old before the expense ratios really shot up. Those are not bad. If you have one of those, it might be worth hanging on to. If you don't know if you have one of those or not, or you don't know what you're paying, and send us, we'll tell you what information we need. Typically, all we really need is a copy of your most recent statement, whatever that is. We get a copy of that. We'll analyze it. We'll break down all the costs, what you're paying, what your options are. And there are lots of times where you can actually keep a death benefit or an income rider and move the vast majority to a partial 1035 exchange and lower the expenses that you're paying on the rest of the money. So that's a good idea. If you are in a position where you've got a lot of taxable income, you're making a lot of money and you're in top tax brackets, it makes a lot of sense to have the investment-only annuity. You're not really concerned about the death benefit or having a living benefit. What you really want to do is lower your current taxes. Awesome. Take your investment accounts. You've got every fund you can possibly imagine. All the categories are covered, and then some, quite frankly. Personally, I don't think they need 360 funds. But that's what you have choices of. And you have Vanguard, T. Rowe Price, all the low-cost providers in there, and some ETFs in there. It's a great idea. I think it's a phenomenal idea, especially if you're in a really high tax bracket. You take that money, you put it in there. You don't get a 1099 on it. There is no limitation like there is for a Roth IRA or a regular IRA contribution. You can put as much as you want in there. If you wanted to put more than $10 million into it, we actually have to call the company, get approval for it before they'll accept an account that large. There are insurance reasons for that. Actually, administrative reasons. It doesn't have as much to do with the insurance as it does the administration. You're not really buying insurance on this product, by the way. All you're doing is buying the tax deferral. They charge $20 a month for that. $20 a month for mortality and expense charges. That is phenomenal. All those choices, if we're managing it, you don't have to have us manage it. If we're managing it, we have a fee. That fee comes out of there, counted as a distribution, but you are able, if you can itemize and it's above certain levels of your income, you can deduct that too. So I will tell you, very few people qualify to do that, but it's an option. What's really important, I've got people are in higher tax brackets when they retire because they've done very well, they've saved, they've invested, and now they're going to have to pay taxes on their Social Security, and there's this surcharge on Medicare they might have to be paying taxes on. If those gains in your taxable accounts are deferred, that is not counted in your income. They do not add it back for those calculations the way that they will tax-free bond interest. And you guys that are having that happen to you, you know what I'm talking about. The tax-free bond interest gets added back into your income. It does not happen with an investment-only annuity. You do not have to take it out at age 70 and a half or 6 months after you're 70 and a half. That's the way Congress says 71, by the way. But there's so many benefits to it. It's a really good idea. And so feel free to give us a call to talk more about that. Go to our website, contact us about it. It's something I really plan on doing a lot of work with because there are a lot of benefits for certain people. And other people, maybe not so much. We don't know until we ask you a few questions and find out what you're trying to do. But I've got to take a phone call right now. And I got Daryl, Broadview Heights.
Good morning.
How you doing?
Better than I deserve. Thank you. And you sound great as usual.
Oh, well, thanks. Yeah, I think some people would disagree with that, but that's okay. It's what makes the world go round.
I think I'm pretty objective. I was wondering, with the possibility that Mrs. Clinton will be elected, have any of the companies that manufacture firearms come up on your scans?
They came up a few months ago, and actually a lot of them ran quite well. And a couple of them over the past 24 months have shown up in our momentum models from time to time. But, the gun, I don't know. It's really difficult. She's going to have to get an awful large percentage of the Senate and Congress to go alongside with her to get any substantial changes done in that area. And I just don't see that happening. I don't think she's going to get enough support from the Republicans and the NRA supporters. They're not all Republicans, by the way. There are a lot of Democrats who support the NRA. So
I agree.
It'd be.
However, when Mr. Obama got elected, there was a feeding frenzy both times. As soon as the day after the elections, there was a run on firearms and ammunition. There was a feeding frenzy. Prices skyrocketed. 22 long rifle ammo that you could buy for under $20 for a brick of 500 ran up to $90.
Yeah, I remember that. It was not just in that range either. Try to get 9mm or 45. Was all it skyrocketed. If you could get it, some places literally ran out.
The manufacturers geared up production dramatically, and now the prices are way down. They're actually down to the levels they were before Obama was elected the first time.
Yeah. And people say a president cannot do anything by himself. He has to have support of Congress and the Senate. He has to.
And it's like the stock market, Bill, though. It's the perception of being able to do something.
Yes. So the perception, and this is where people who make better than average returns separate themselves from the crowd, from everyone else. They actually try to figure out what the perception is, and then whether or not it's justified. If it's not justified, they take the contrarian position, and eventually, if they're right, they get paid. So that's what you're asking me to do is to actually predict what the vast majority of the American public and the Senate and the Congress are going to be thinking in their minds months ahead of time. Now, I'm going to ask you, you're married, right?
Of course.
How many times are you able to tell what your wife is thinking at any given moment?
Less than half.
I got to take a real quick commercial break. Did you want to hang around?
Yeah, I will, because I want to ask you one more.
All right. You're listening to Bill Bullington right here on the Bullington Capital Report, 1420. I'll be right back after these messages. And we're back. Mr. Benarski, you still there?
Yes, sir.
Hey.
So the question would be, do I buy ammunition or the manufacturer's stock?
I don't. I really don't. What you're doing is you're trying to ask me to predict the future, and I'm surprised you're still asking me that question. By the way, as many times as you've heard me talk about that, it doesn't matter.
It's rhetorical.
It doesn't.
It's rhetorical,
it's fun to think about. Yeah, and it's good. It's good fodder for having conversations, but it's not very good for helping your investment process. Yeah, because trying to do that, if anybody could do that, by the way, they would be so rich. They would be much richer than Warren Buffett. Because if you could accurately predict even one major event like that, I can show you how to make so much money without having to have a lot of money, that you would be super rich. Okay. So that's how difficult that is. It's kind of like winning the lottery. If you hit one of those, it's not going to be because of skill. You're going to get lucky. So if you want to keep doing that, you better have a large pool of assets to start with, because you're going to lose on a tremendous number of them before you actually hit one of those. And at that point, you may just end up just getting your money back because of all the losses you made. But anyway, hey, I want to talk about the Shackley thing. I know we've been talking about, and we haven't really mentioned their name. And I was thinking that's not. I would do that. It's a great idea. That product that I've been using, that product now, that thing is unbelievable. For light duty cleaning, and all you do is there's a soap. It's called H2. You just put a slightly different amount in the 3 bottles. So you got one super light, like glass. Then you got one for slightly heavier, like your countertops in your kitchen. Then you have another one for a little bit tougher stains. But for everyday general cleaning use, that product it's mind-boggling. And for the price, pardon me?
I was going to say, I transplanted a little hemlock tree in my yard the other day, and I watered it with a little bit of Miracle Grow in it and a few drops of that cleaning product, because it's a surfactant, and it makes the water wetter, so that when you pour it on the ground, it soaks right in.
Oh, that's awesome.
In fact, it's used by farmers as a surfactant for standing water. So
I remember
standing water will penetrate.
I remember you telling me that.
We used to do a demo and put water on peat moss, and it wouldn't soak in, and then add a drop of that product, and it would soak right in. It was amazing.
Yep,
you can shave with it. You can wash your floor with it.
I keep finding new uses for it. Yes, it is. It's a phenomenal product. And what's really interesting is if people want to go to your website to sign up, they can actually become distributors if for no other reason than to get a discount on the product. That's a good reason. Yeah.
Big discount.
Yep. But the better reason, I think, is that if you're really looking at a way of creating a second source of income, you might want to consider signing up as a distributor. It's a really good product. I just can't even say enough about it. Not because I am anal about that. I mean, especially my kitchen countertops. I have this paranoia that I'm going to get bacteria. It's going to get in my food somehow, and it's going to make me sick. But anyway, so I thought we'd talk about that. That's NutriSkis.com if they want to learn about the business opportunity. Is that correct?
Yeah, and the system that we have, they don't have to sell products to their friends and relatives.
Right.
We can show them how to market on the internet and never have to beg their friends or relatives to buy anything from them.
That's awesome. That's what I think most people are most interested in. But I'm going to have to take this other guy's phone call. He's been on hold now for a while. But call back in next week and we'll talk more about it. Okay, have a good weekend.
All right, Bill.
Bye-bye.
You too.
And I got J.R. and Solon.
Hey, William.
Hey.
May we talk about some local stocks this morning?
Sure.
Okay. First one, Third Federal Savings and Loan. Excuse me. Third Federal Savings and Loan.
Okay. I am trying to look up the symbol for it. I haven't looked up that in a long time. Do you know what the symbol is?
That was selling at quite a discount. It's moved up a bit.
Do you know what it's...
Now it's probably back to normal, but...
All right, we'll have to come back to that one because I can't remember the symbol right now, and it would be unfair to make everybody listen while I looked that up. But you have another one for us?
A. Showman.
Another one that I... Actually, I can't talk about that one because someone in my office works in the accounting department there. The spouse works in the accounting department there. But you can call me.
Wow.
I can give you an opinion, and we're not allowed to disclose anything that the public hasn't already seen or heard, by the way, because that's illegal.
Of course not.
But,
you can go to jail for that type of thing.
Yes, you can. And I don't have the same attorneys that those billion-dollar hedge fund managers do.
How about Lincoln Electric?
I like Lincoln Electric quite a bit. The chart doesn't look really good. If Lincoln were to come up on one of my models, I would buy it. In fact, the guy called in a couple weeks ago and was asking about Bristol Myers, and I'm like, I'm indifferent about it because it's fully valued. So I look at it, and then that very week when I reran my high dividend model, guess what comes up? Bristol Myers. So now I am an owner of Bristol Myers because it's in one of the models that I run, and I know not to question my model. When you question your models in the long run, that is a recipe for underperformance. It got into it, but I love Lincoln Electric, and they do some wonderful things. I think it's a great company. I think it's very well managed. One of the few manufacturing facilities that's still here, in the Rust Belt, and they're in one of the toughest industries you can be in, welding equipment. What could be more generic and under attack by low-cost producers than welding equipment? But they're into all high-end welding equipment, the robotic stuff. They've got a training facility.
They've diversified across the board, though. They not only make the equipment, they're selling the razor blades as well.
Yeah, well, they do a lot of different things. In fact,
all the wire and all that type of stuff. They're much more than just welding anymore.
Well, you should see what they do with the robotic stuff. I mean, it's mind-boggling that's in Cleveland, and they've got a training facility here in Cleveland. Kids that are looking for a career, you might want to consider that. It's a heck of a lot cheaper. It's about half of 1 year's tuition at a state school, and you can get it done in less than a year. And
wow.
That field, all the trades, skilled trades, the old timers are retiring, and the young kids are not training for those positions. So there's a lot of opportunity there, and they're pretty good jobs. And you can get as high as it's kind of fascinating. So if you go to their website, call me. I should, in fact, about a year and a half ago or 2 years ago, I think I talked to somebody there. I should get them on the show to talk about that because it is a really good opportunity. You can make big bucks without having to go to college. And a lot of it, you qualify for some financial aid for it the same way you would college. So, people don't know about that. If I were coming out of high school, I wouldn't go to college. I'd go to that school for sure. And you're not going to be welding, car parts together unless you want to. Right. If that's what you like doing, then hey, you can make a good buck doing that too. That's just kind of.
I was going to ask, how about Nordson?
Let me see. I remember Nordson. I'm going to pull that one up here real quick. There we go. The chart looks really good on Nordson. It's been under accumulation now. It's run up quite a bit. Back in January, stock was down around $50. It's at 96 now, so it's up almost 100%. I'll have to pull up Y charts on that and take a quick look at their fundamentals. And understand, everybody else that's listening, I would never buy or sell a stock based on 5 seconds of research.
right, of course.
But I give a decent idea as to whether or not the stock is underpriced or not. And that's something that I keep saying I'm going to put out in another ebook, and I've got part of it written. It's not completed yet. So the market value in that company is $5.4 billion. The revenue is $1.7 billion. At that rate, right off the products used for adhesive coating, I'm not real interested in that. Now I got to double check those numbers, by the way, because occasionally the numbers I'm looking at are wrong. But based on what I'm seeing right now, I wouldn't be really enthused
fully
about
valued.
that. Yeah, absolutely. Yep. So, but anyway, I got a few seconds to go, Jerry. I got to take off.
Okay, very good. Thank you, Bill.
Have a good weekend. Thanks.
Yeah, bye-bye.
And feel free to check out my website. If you want to learn more about this, feel free to go and download the radio show. If you heard something you want to hear again, I can see it there. It's on iTunes. You can go to my website. It's there too. Feel free to email us a question as well. You've been listening to Bill Bullington. I'm here every Saturday morning from 11 to noon on 1420. We also air 6 o'clock at 1220 on a sister station. And I believe at some point in time, we're actually going to be on an FM signal. So that's pretty interesting. Anyway, again, feel free to contact me, Bill at Bullington Capital, if you have internet access. Other than that, have a good week and good investing.
You can call him at 330-664-0700. That's 330-664-0700. Or contact him through his website, bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and or investment strategies recommended and or purchased by advisor, or product made reference to directly or indirectly will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
The preceding program has been paid for by Bullington Capital Management, LLC.
The preceding program's views, claims, or representations may not reflect those of AM 1420 The Answer or Salem Media Group.